Good afternoon. I'm Mark O'Hare, and it's my pleasure to be here at Super Return China in Beijing, where I'm talking with Gary Rieschel, the founder and managing partner of Qiming Ventures.
Yes.
Gary, there's a lot of growth capital, a lot of venture capital, a lot of real estate, some buyout in the Chinese market. Tell us about Qiming and what your focus is.
So Mark, Qiming was founded approximately 7 years ago. We are an early stage venture capital fund. We manage about $1 billion spread over 3 funds and about 1 billion RMB spread over 2 RMB funds. Most of our investors are endowments and foundations. From the beginning, one of the things that we did with Qiming was focus on particular sectors. So we have a dedicated team that does clean tech, a dedicated team that does healthcare, a dedicated team that does consumer internet, and a dedicated team that does IT. Since we do a lot of early stage investing, we need to have a little more technical expertise in terms of underpinning those investments.
$1 billion US is pretty big for 3 early stage funds, Gary.
Well, so the first fund was 190, second fund was 320, and the last one was about 450. Because we do a mix of early and late stage, it helps absorb some of the capital. And some of the sectors, such as clean tech and healthcare, some of the investments can be pretty substantial.
Right. But just to be clear, in say the clean tech space, you're investing in the technology or in the projects, as it were?
Yeah, we don't do project finance. So we're typically investing in companies that would have services or technology that would then be contributed to a project. Right. 90+% of the investments we make, whether it's healthcare, clean tech, or consumer or internet, would have a technology component to them.
Gary, let's talk about those 3 sectors in turn. Maybe if we start with clean tech. China's obviously very big in the solar business and the manufacturing stage, but I guess you're probably involved on a broader basis in clean tech.
Well, in fact, alternative energy such as solar and wind are things we consciously chose not to invest in China. There's no real barrier to entry, and the cost of capital here for the state-owned enterprises has been so low that you have unnatural levels of competition. You have over 100 manufacturers of megawatt wind turbines. You have 130 some odd suppliers of PV panels. So we just don't understand how anyone could make money in those businesses. What we did on the clean tech side is look at what are the trends, what are the things that China absolutely has to take care of. So we have nitrous oxide emission reduction in coal-fired power plants. We have waste to value in terms of steel gas being converted into high-value chemicals through a microbial fermentation process. We have several investments in wastewater treatment, and then energy storage and distribution. So we've been very careful to look at sectors where we're not going to have just an undue amount of competition due to cheap capital.
Now, Gary, I happen to sit on the board of a clean tech investment trust, as it happens, as well as my day job. And one of the things that concerns me about clean tech is the amount of capital that's invested for non-economic reasons and is relying on state intervention and support and so on. How do you address that sort of issue?
Well, I think that this is part and parcel of the other comment in terms of the amount of capital that goes into the sector. We don't like investing in a business that is dependent upon the government subsidy, ultimately for its success. Right. You might get lucky and you might get bought out, or you might have a timing issue where you could take a company public, but fundamentally, those kind of subsidies distort the real value in the market. And I think that's been one of the tragedies of the clean tech sector, is that people were counting on it's the right thing to do, and they were approaching it from the societal standpoint, which may very well be true, but the economic underpinnings were really flawed. And I think that's cost investors a lot of money.
Indeed, but you're focusing on niches within clean tech where you see it being driven, I guess, by implication by the economics.
By the economics. And what's interesting, for example, though, in China, one of our portfolio companies that works on nitrous oxide emission reduction, LPMINA, until the Chinese government began enforcing their own emissions law, this company had no business. So when we invested, we forecast a market coming to fruition over a 2 to 3 year period, and it took 5 to 6 years, simply because the government at the time wasn't willing to enforce its own rules. And so I think that's one of the reasons that we tend to be, you want to make sure that you're right in terms of the direction you take, because there are going to be other variables that we don't necessarily control.
Absolutely, absolutely. So that's the clean tech space. The other two are healthcare and consumer, both relying on the middle class story and the urbanization story, I guess. Tell us about your interests in consumer.
So consumer, what we've done is we've done restaurant chains. We have done, actually have an investment in what is now the fastest growing company in the history of the venture capital industry, a company called Xiaomi. The founder, Lei Jun, is building an Apple-like, iTunes-like ecosystem around the Xiaomi phone, and in its second year in sales did $1.7 billion US and was very profitable. So no company in history has ever grown this fast. So that's a good example of, here on the consumer internet, you can see technology innovation, you can see business model innovation. He sells all the phones off of the website. They don't go through a channel.
Right.
There's no subsidy provided through the phone companies. He's just building an outrageously great product. And I think that we're lucky in that we could have found an entrepreneur like that. But we have a wide variety of investments on consumer internet, because if you look at electronic commerce, you look at online activity, young people here, even up now to 35 and 40 years old, spend multiples of the amount of time that Americans spend on the internet. Americans still spend more time watching TV than they spend on the internet. In China, that's exactly the opposite.
And tell us about healthcare. What interesting areas are you finding in healthcare at the moment, Gary?
So healthcare to us is, of all the sectors that we invest in, the most predictable return profile is going to come from healthcare. The Chinese government about 5-6 years ago did a very, I think, focused reformation, restructuring of the healthcare industry. And if you looked at the percentage of GDP spent at that time, it's about 2.5%. Now it's up to about 6 to 7%.
And the US would be what, 15, high teens?
Close to 20%.
Close to 20,
if you include everything.
For comparison.
I hope for China's sake it doesn't go down the US path, because it'll bankrupt the country.
But maybe there's a bit of room for growth.
Exactly.
Yeah.
And so what you have here is you have, across a very broad range of healthcare technologies and services, whether it's hospital care, whether it's rehabilitation centers, whether it's retirement homes, across a broad range of pharmaceuticals, all the macro and micro factors are very positive for healthcare. If you look at one particular area, just look at what happened with pharmaceuticals. 10 years ago, major multinational pharmaceutical companies did not bring those technologies to China early. They were worried about intellectual property theft. So what they typically did was they brought them in right before they went off patent and issued a generic version at a much lower price. Now all the major multinationals come here early because there's enough wealth in the country, and the lifestyle disease, unfortunately for the Chinese, has exploded. So a lot of those really expensive, high-value drugs, this is now the world's largest market for those products.
Gary, finally, all of this happens against the backdrop of what's going on macroeconomically in China. We've heard a lot about the rebalancing of the economy that's needed this morning, and concerns as to whether that leads to a hard or a soft landing. What's the macroeconomic view that you have and that informs your investment activity?
Well, I think what I find interesting is people talk about a landing in China. So the landing is 7.5% growth.
Well, this morning we heard 2 to 3% possibly.
Well, so Professor Pettis, with all due respect, has a particular bent, and you could have 20 other economists with still at 7.5 to 8%. The way that we think about China is very simple. At the scale of China's current economy, let's say it grows 6% this year, it'll still add nearly $500 billion of GDP, of economic activity. So if over a 4-year period, if it just grew 6% and then down to 5%, it did that over the next few years, you'd add the state of California or the country of India. As a private equity investor who can basically invest through troughs over a 7 to 10 year period in venture capital, wouldn't you be interested in investing today at base zero in what would be California in 4 years? I think that's a hell of an investment story.
Sounds pretty compelling. Gary, thank you very much.
My pleasure, Ron.
Thank you.